Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora koutou and welcome to the fourth episode of Markets, Mystics and Mayhem. This week we're going to talk about China. China's our largest trading partner, has been for a while. But geez, the Chinese economy is struggling. So too is the New Zealand economy. So we're going to talk a bit about how these two economies are performing, what's most likely to happen, and just how we're so related. I'm also going to tell you what scares the living daylights out of me. Obviously involves China, so we'll talk a bit about that as well. And then we're going to get Hamish Wilkinson on, one of our FX dealers, and we'll talk all things currency, not just against the big dollar, but against euro, yen, sterling, any other currencies that you can think of. So let's get into it. Big week, lots of announcements. MJ, can you tell me what's going on in China?
Yeah, okay. It's gonna be a big topic. But I guess let's just talk about the starting point and what China means to our economy. So as you said, China is our largest trading partner, and they have been since they booted Australia off the top of the podium in 2017. But before that, they'd been our second largest trading partner since 2013. So they've always been an important market. In terms of the detail, I'm going to rattle off some stats. Total trade value as of June 2024 was sitting at 9.5 billion. China's our top export destination. They account for 21% of all exports, with dairy and forestry being the top two products. On the import side, China's our second largest source after Australia. They account for 16% of all imports. They come from China, with machinery being the top product. So we do have rather a strong trade surplus with China of about 1.3 billion. It could be better because we have our goods exports. They're doing relatively well, which is good for our dairy farmers. Fonterra, they had a pretty good result with the second largest dividend in history. And they have a pretty good forecast for their milk prices going forward. But the service exports is where, the performance is lacking. And that largely comes down to weak tourism flows.
Yeah, so we've had quite a few announcements, I guess, in recent times. I thought it was interesting, Fonterra reporting such a strong result, massive dividend, but also quite a high dairy price forecast. So that's good. In New Zealand, when we have these, spikes in export prices, it has a really large effect on the economy. So if you can think of, dairy prices increasing, farmers obviously getting more money, they spend more on their farm and around their farm, and that just feeds, directly into the economy. Whereas in Australia, for example, if you see a spike in, the price of iron ore, well, that's great, but that filters through, BHP and Rio, and it doesn't quite hit the economy as hard. So this is good news that commodity prices are recovering, but as you say, that's goods. Goods is good. What's happening with the services? So why haven't the Chinese tourists come back?
Yeah, that's really the big missing piece. Really, tourism was our largest export industry, but post-COVID, it hasn't quite returned to that status because we are missing the Chinese tourist market. They're a pretty important market, and they will be going forward. And it just goes to just reflects how weak their economy is. So their economy has been very weak. There's been no appetite to do a long-haul travel that's very expensive. So household spending there has been quite weak, and that's been translated to us, where we've seen really weak tourism flows from China. And that is holding down our tourism market overall. So the true test will really be this summer. That's our peak international tourism period, and we'll see how much stimulus. So the Chinese government's added all this stimulus into their economy, and we'll see how that actually impacts the domestic consumer there, and whether they do end up coming over the summer.
Yeah. China, or policymakers over there, they're targeting 5% growth, and they're falling short. So the only way to get that is with a lot of stimulus, particularly with the crisis that they've had in their housing market, which has impacted housing and households, I should say. Outlook, what are your thoughts? Where's the economy headed, I guess?
I think for both our economy and the Chinese economy, I think 2025 is going to be a much better year in terms of growth, because our central bank has started cutting rates, and the Chinese economy, they should start to pick up with all the stimulus coming through now. Whether it'll be enough to see the 5% target achieved, we'll see. But there's been a lot of stimulus coming through. They're cutting down the mortgage rates for existing borrowers. It's making it easier for second home buyers to purchase another property. There's been a lot of support for the equity market as well, so that should help the domestic consumer there. Also available of credit. It's going to be a big one. So I think 2025, it'll be a growth story for both our economy and the Chinese economy.
Yeah, and that's interesting. I think the performance of our economies really has played out in the stock market. So the US stock market has performed way, way better than ours, and that reflects a relatively strong economy. The Kiwi stock market has lifted a little bit recently, but it's pretty much gone sideways for the last couple of years, again reflecting 2 years of recession. And then if you look at the Chinese stock market, it's down 40%, 40% in the last 4 years. And I think, again, it reflects the crisis that they've had in their housing, the weak economic outcomes for quite a while. But as you say, it's turning around.
Yeah. So China is our largest trading partner, we said, and there's some upside, growth potential there as our economies pick up in terms of activity. But, we shouldn't always be focusing on China if we're talking about a long-term growth strategy for us. I'm going to ask you, Jared, what keeps you awake at night when we're talking about the future for the New Zealand economy?
Yeah, I'm going to say the same thing that I've said for, over a decade. It's geopolitics, particularly in the Pacific, particularly, with China, flexing its muscles and wanting to have more influence in the area. So we will find ourselves stuck between a rock, United States, and a hard place, being China. If there's any tension between these two, we're going to suffer. And what scares me is China's willingness and ability to hurt us. If we, put one foot out of line in their eyes, they can quite easily just turn around, as they have done in the past, and say, no more tourists for New Zealand, no more dairy out of New Zealand, no more, wood, meat, whatever. They can just cut our trade. And, we're not making this up. We saw the Chinese do this to Australia on a few goods. We saw them turn the boats back during the 2008 crisis out of Australia. So, that really does worry me. If we see the US and China going at it, we're going to get hurt.
Yeah, and I think we're just so exposed to China. We kind of saw it as well during the pandemic when the COVID sort of started in there, and then we just saw how their influence was widespread, and we got hit from that. We'll also get hit double time because Australia is our second largest trading partner, and the US, China is their first largest trading partner. So we kind of have this double whammy if there is a Chinese-led slowdown in Australia. But if that is the sort of issue that we face, what would you say is the solution going forward?
Well, just as people diversify their assets, we need to diversify our trading partners. And the most obvious trading partner is India. We need a free trade agreement with India. It's taken way too long. We have been working on it, as far as I'm aware, since at least 2010, trying to get better deals. We need to accelerate that. cut the excuses. Let's sign some documents. Let's get into India. Let's get in there hard and fast, because when you think of demographics, China's population has peaked. India's population doesn't peak until 2070. India has more people than China right now, today, and they're going to have a lot more growth over, I think, the rest of my life than anywhere else. And I'm planning on living for a long time just to annoy my wife. So, that is the area I think we should focus. And it's not just India either. There's a lot of countries in Asia that we could be doing more with, whether it's the Philippines or Vietnam, doesn't matter. There's a lot more that we could be doing in the region.
Yeah, it's just the same as that. As you said at the beginning, don't have all your eggs in one basket. And I think we need to have that approach going forward in terms of our export strategy and our growth strategy. So it's not just about China. They're important to us, but there are other places to look at as well.
Absolutely. New Zealand, we need to diversify.
That's the call to action.
All right, now we're going to get Hamish Wilkinson on, and we're going to talk FX.
All right, so now we're joined by Hamish Wilkinson, an FX dealer in our financial markets team. We're going to talk to him about what he does day to day, but also a really one of our favorite publications, which is called the FX Tactical, talking about where we think key Kiwi crosses are going and not just the Kiwi-US cross. But Wilkie, thanks for joining us. Why don't you take us through what you do on a daily basis?
Thanks for having me, guys. I'm a senior dealer in the markets team. I look after sort of the bank's, larger customers, whether they be sort of main bank by Kiwibank, or also we have multi-bank customers. So, a large customer, for example, may kind of have 2 or 3 different banks set up in terms of seeking FX and interest rate pricing, and so I just tend to look after that sort of level of customer. So I specialise in FX and also interest rate risk management services.
Oh, interesting stuff. So you obviously are in talks with clients all the time, so we're keen to hear any insights you're getting from them as well. But in between those calls and we're breast kidding and all that stuff, we do this FX Tactical with financial markets team.
Yep.
He's got it.
Pop in here.
This is looking at currencies and where we think they're going, sort of a 3-month view. And we're not just talking about the US dollar, but we already, for the last 3 episodes, we've been talking about the US dollar and our expectation for it to go lower. But why don't we talk about the other currencies as well?
Yeah, sure. I guess the founding basis on most of currency calls as such tends to be sort of around the US dollar, and I guess expected interest rate paths of specific currencies. And obviously you guys have been pretty bold in some of your calls in terms of obviously where the RBNZ should be likely to be going to over the next few months or even years. So that kind of sets the foundation in terms of obviously the tactical itself. I guess for yourself, JK, is you've been kind of long calling for the RBNZ to get moving, even as perhaps of early as last year sometime. And so obviously that's probably predominantly why we've sort of had quite a bearish picture on the New Zealand dollar. Now obviously the RBNZ are underway in terms of, albeit a little bit delayed and a bit perhaps confused, you could argue. We're underway in terms of obviously the rate easing path. I think probably from a broader global central bank perspective is that most of the sort of the currencies that we tend to follow, probably with the exception of the RBA and the Bank of Japan, a similar sort of path developing in terms of sort of that global currency environment. And the major thing in terms of focusing on, I guess, interest in terms of currencies specifically is kind of that broader interest rate differential effect that you see coming through in terms of central bank and interest rate expectations.
Yeah, it's a fascinating period, right? So central banks generally move like a herd, and we've seen ECB, BOE, the Fed doing a 50, and then the RBNZ. So they're all cutting together. That's why I love interest rates, because interest rates, they can all move up and down together. It's like pure poetry. Whereas FX, one goes down, the other one has to go up. It's way too difficult.
Yeah, well, that's where it gets a little bit harder, right? In terms of, obviously interest rate guy you are. We like to think us currency guys are a bit more smarter, having to sort of deal with two interest rates at one go. And that's obviously what makes currencies kind of hard in some respects. And in terms of the tactical, sort of the approach that we take is kind of looking at it on a quarterly basis because, as you guys know, things change real quickly. And even actually after we published the tactical last week, we had... obviously the PBOC come out with obviously a range of stimulus measures, and that sort of caused obviously I guess a bit of a risk on mentality through markets, and the Kiwi dollar actually rallied, sort of going to get a little bit against our call, but ultimately I guess probably from a more broader sense, if we sort of step back and sort of look at sort of the expected path and the fact that we believe obviously the RBNZ need to get going and get going fast, we sort of think next year is looking still predominantly for a sort of a downside view on the currency, albeit at a little bit higher level than perhaps we were previously in the year.
Yeah, exactly. I mean, the Kiwi economy is clearly underperforming, and I think the Reserve Bank's going to have to do more. But so Kiwi US, got it. It's gone the wrong way. It's gone from 60 odd to 63 odd now. That's gone against our expectations, and then I guess we still forecast it falling, into the 50s next year, possibly 59. What about euro, sterling? What's going on in Europe?
Well, I guess in Europe, probably the key sort of messaging we're getting from central banks, ECB and the Bank of England, is perhaps been a little bit cautious. They're obviously easing policy, but they're easing sort of looking to ease in perhaps an elongated cycle. So whether it's every second meeting, they may be moving in 25 basis points movements. That seems to be sort of quite dynamic in terms of that view. And certainly in the UK, obviously, they had a massive spike in inflation and they pumped their interest rates very, very high. And I think the Bank of England are quite mindful of I guess a sort of a reflaring of inflation pressures, and so as a result of that, sort of whilst rates are trending lower in both Europe and the UK, again it perhaps may be a more gradual affair than perhaps we may see from the RBNZ, and so as a result, as the tactical sort of says, and encourage everyone to have a read of it as such, as sort of we still hold a sort of a downside view. Technically, those currencies are now moving into perhaps lower ranges, particularly from a Kiwi sterling perspective. Actually we touched on sort of post-Brexit lows last quarter, and so that's quite significant from a technical perspective, and so hence probably there is a continued argument to see sort of that particularly Kiwi sterling edge lower over coming quarters as such.
Any other currencies worth a mention?
Bank of Japan, I guess. That's probably been the biggest movement of over the last quarter. Kiwi yen has been, had some volatile times, and it's really sort of driven from, I guess the combination of the Bank of Japan starting to, increase interest rates, albeit very, very slowly, sort of heading towards current settings around about 0.5%, but pushing potentially up to sort of that 1% mark, whilst at the same time we're moving into sort of obviously the Fed easing rates and the volatility that we're seeing out of the back of that. It's sort of been a wait and see type sort of movement, but it kicked off certainly in August, particularly obviously on the back of the market taking in a weaker jobs outlook in the US, and obviously we saw some quite significant financial market volatility across all markets through that period. And Kiwi yen sort of saw, I think it was about a 16% movement across the month of August alone, albeit has rebounded. But certainly, again, same sort of argument for Kiwi yen as, the fact is that we believe obviously the RBNZ to be moving lower next year, and Bank of Japan obviously slowly, very, very slowly, but going sort of obviously in the opposite direction.
Yeah, I remember when I first started in this gig, I was working at JP Morgan, and we had I got on quite well with one of the Japanese economists. And I'm like, please explain to me, how the hell are we supposed to look at this economy? And he said, everything that you know, reverse it in your head. Right, prices fall, wages fall, and it's like a very very rapidly aging economy, and it's in its own little league. And here we are talking about 99% of central banks cutting, and we've got the Bank of Japan going the other way, which is good for them, right? It's good. If they've come out of negative, they're starting to try and get some positive interest rates happening. It is a big shift for them.
Well, you're a big demographics guy, right? And sort of that longer term interest rate sort of cycle, and there's arguments now coming through in terms of obviously Japan getting through that aging population bubble, and as a result, sort of who's going to obviously sort of pay for the next I guess stages in terms of their care, and hence obviously the inflationary pressures that potentially may come through as a result of that, which is, again, in my time in markets, I've sort of known the same thing, is that Japanese interest rates don't go much above zero, and then we're sort of moving into a strange world for perhaps a lot of people.
Yeah, absolutely. And China, that they've only just started that aging population. Their demographics look quite difficult or awkward to say the least. So
I guess for Kiwi yen, sort of we sort of believe that's obviously on a downward path just for the foreseeable future. I mean, again, currencies, as we've talked about, it's kind of notoriously hard to sort of depict sort of that shorter term volatility, but I guess if you look at it, an interest rate differential effect over the course of the coming year or so, they'll be volatile in that cross, but generally we sort of think that probably now we've seen a peak of it up at 98 or so.
Well, we're running out of time, so that was great. So thanks a lot for coming on. We'll have you back.
Thanks for having me, guys.
And that's it from us for this week. Done.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.